Hi there, I'm David, and today we're going to talk about venture capital, startups, and all that crazy stuff that goes along with it. So let's get started. All right, so what is venture capital and how does it differ from an angel investor? Well, an angel investor is an individual, typically one who had previously had a startup and sold it, and with the money that they have now, they are investing in other startups or other programs as well to help them get moving along. Venture capital is essentially a corporation or an entity organization which takes money from other individuals like pension funds, individual investors, and then they invest it in several startups instead of the angel investor maybe having a few here and there, because investing in startups is a very high risk and potentially high reward system. Well, venture capital takes its roots from around World War II, even though equity happened before that, so private equity or private investment. So in 1946, Georges Doriot, an American Research and Development Corporation founder, had raised $3.5 million to invest in commercialization of World War II technologies that were invented to fight the war and develop various tactics and techniques to improve everything that was going on at the war front. So this World War II technology was then being commercialized to give it to the people, the population at large. So he was investing money in these companies, or something like a startup, but back then, and he originally invested $200,000 in it, and it ended up turning into $1.8 million in 1955 when it went public as an IPO. So, what can we take away from that? So what is the difference between venture capital and a bank? Why can't a startup get a loan from a bank? Well, because a startup might have a brilliant idea, it's still very high risk, and a bank isn't going to throw money at it because of that high risk and low potential for there being a reward. And to be honest, it's usually about 1 in 10 to 3 in 10 startups that actually succeed according to different statistics from venture capital corporations. And of course, there are venture capital corporations and entities, organizations that will invest in specialty technologies or special industries. It can be very specific or very broad. It all depends on them. So the startup must be scalable. Something that's not necessarily scalable is like a gas station. You have one building and it will take a while for there to be another building. Of course, you can spread across the country over time, but scalability isn't like you can have your gas station at every street corner across the world in 5 years. Whereas something in the technology industry, like maybe a new technology in regards to satellite communication, making it near instantaneous, maybe, I don't know, quantum Zeno effect. There you go. You keep it in a state of quantum, go back to our quantum physics videos, and you have it communicate that information across a quantum entanglement system. So that's something that would be very scalable at a very rapid rate all around the world, and a venture capitalist would likely plug some money into it, hoping that the reward will be high. But what are the benefits to this to you? Well, let's run through a few. You'll have faster growth at the initial outset of receiving the capital. You'll have a head start compared to your competition if you have any. You'll be able to attract good talent, but not just attract good talent. Venture capitalists want you to succeed because it's in their best interest. So they have different tools, such as human resources tools and networks, that can help you out. And networking. Networking through the venture capitalist firm is also in their best interest. So they might have a contact from another organization that was working in a similar field that your business is, or it could just go, 6 ways from Sunday. However, that said, there are some cons, some very potentially negative cons to accepting startup funding from venture capital. You will have a smaller percent of ownership. That's just it, bottom line. You may lose control of your organization as they sit on the board, especially as time goes on and you end up going through different rounds of investments. You might be giving up too much of a percentage of your company every single time. And if you are the CEO or director of a company that has a board of directors, you can be kicked out. There is a commitment to exit. The moment you accept venture capital, there is an exit commitment. Your company, your baby, your child will go bye-bye at some point. And at least the form that you started with will not be the form that you end up with. There are many routes that this can go, and we'll talk about that in a moment. It can also be very distracting. So, for example, it takes a lot of energy to get the attention of venture capitalists and also of angel investors. And one of the main things of this is that you need to study and understand that they don't care about your business plan. They care about the idea and will ask you a lot of very difficult questions throughout the process. Why is your startup different than startup B? They seem very similar. What makes you special? What makes you think that this is scalable, it'll grow, be successful? And another problem that can happen is that the venture capitalist might not be a very good business partner. It is recommended in some circles to ask the venture capital representative to speak with a previous startup director that may have failed. And if you talk to them, you can ask them about that particular firm, VC firm, and how they behaved. That's just a recommendation that floats around the internet. So when you commit to an exit strategy, there are 3 methods that a venture capitalist firm can use to exit. Angel investors might so-so be tied into this as well, but from the venture capitalist perspective, exit strategy is to sell their stock in your company. The first exit strategy that a venture capitalist or VC firm might use is to sell their percentage of ownership within your organization or company to another venture capitalist firm or organization. So this means that they will be transferring their percentage of ownership over to another venture capitalist firm, which could be really good or really bad for you depending on the first and the second one's intent and how they want to run things from there. The second one is that when you do eventually establish an IPO with your startup during a later phase of development in your company, they will sell all of their shares of ownership within your organization to receive the payout from the IPO timeframe. Now, the stock market is a very fickle beast, and the value of stocks that represent a company are not valued by the actual value of the company. They are valued by what is perceived as the value by those who purchase and hold the stocks. Usually, it's its own thing. And the third exit strategy is that they will have you sell the company and take their cut, their percentage of ownership. Now, before we get into the whole percentage of ownership, let's get into the life cycle of a startup and company in general, because not all companies began as startups and not all startups end up being companies. So the first step is to have an idea. I want to make a new type of shoe. So during this idea phase, you might go to the bank and they'd be like, whoa, this new type of shoe, that doesn't sound very innovative or interesting. It's just a shoe. Maybe it was the invention of the croc. So any investment that is made here, usually by friends, family, or yourself, is called a seed round investment. After this comes Series A, Series B, Series C, all the way up to however many rounds of investment that you take. Most of the big companies that are out there right now, like Google, Apple, they were invested in by venture capitalists. So the second stage is growth. This is where most of this series of investments will happen, because once a company reaches maturity, it is making a profit, and it doesn't really need money flowing into it. And the last stage of any company is decline. It used to be that when a corporation was formed, and this does all have to be within a corporation structure, it used to be that once their mission was achieved, they would disband, just be gone. Nowadays, that isn't really the case. They find a way to continue their mission throughout the eternal life cycle of everything, which isn't necessarily a bad thing, because we have a lot of innovation from them, and we do need them to thrive as an economy and society. All right, so let's get into the whole system of how you get your percentage figured out that you are going to be giving up to the investor. So there are a few things in valuation, or the value process, determining how much your company is worth, is pre-money. So pre-money is what the company is worth beforehand. Post-money is the pre-money plus the potential investment. And then, of course, we have the investment amount. The percentage will end up being their investment over the post-money, or the amount that will be calculated from the money that was the valuation prior to the investment plus the investment. The owner, you, wants the post to be very high, and the investor wants it to be low. The reason for this is that the percentage will change based on that. If the post is high, well, that means that the pre-money was high. That reduces the percentage of the pie that the investor will have to a very slim amount. And if the amount is low, on the other hand, the percentage grows. So let's talk a little bit about shares, just for a quick moment. So imagine you start up your company and you reach out to a venture capitalist firm and you have 400,000 shares. So between you and someone else, imagine that you've split those 400,000 and you are going to be giving away 25% ownership to the venture capitalist or to the investor that we're discussing here. And you don't necessarily need to give them 25% of 400,000. Those are yours. What you can do is, much like certain banks, is just create more shares. So 25% from 532,000, or another 132,000 shares would be 25% of the total after you've changed it from 400,000 to 532,000 shares. Now, this does create a few problems that there is a system known as dilution. Dilution is the more rounds of investment that you go through, the less of the company you own. And as a result of this, the less decision power you have. Stock creation, as I said, you can create stocks at will, but there's also something called stock splitting, where you take the initial stock and you can split it into more per person for those who already have stocks. So maybe they have one, you can go through a process and split those stocks, and they end up having 2, 3, 4, 5, etc. So if you have any questions, please leave a comment below. I'd look forward to reading them. Don't forget to subscribe, check out other videos, like, share, ring that bell for notifications on future videos, and we'll see you next time.